if you spend 5 lakh rupees a month today and you're 45, by the time you're 60, you will be spending 20 lakh rupees a month. To be able to generate or that kind of money when you're retired, you will need a portfolio of 100 crores.
How much would I need to have in assets by the time I'm 60?
40 crores.
40 crores is a lot of money. I mean, I'm sure it's going to raise a lot of eyebrows. On today's episode, we have with us Sandeep Jethwani, who's the co-founder of Dezerv, a tech-driven wealth management platform. What do you think the biggest mistakes people have made in their portfolio?
We underestimate what is happening with life expectancy. We will live longer. You feel like in post-retirement, I will cut back. But the question to be asked is, do you really want to?
In fact, if anything, post-retirement, I would want to spend more.
We've all heard of how rich Warren Buffett is, right? Do we know that 99% of his wealth was made after the age of 60?
99%.
But the real thing is that he's been around for that long. When you're around for that long, which means you're playing the game of compounding and time, that's really where it you see the value of it.
So you want to start with the first portfolio?
What's the big takeaway? Do you see any stocks in our portfolio?
No.
Do you see any exotic instruments? No, right? And that is the real insight, that you can create wealth with simplicity. You can create a portfolio only of mutual funds and yet get wealthy. You can invest in underperforming funds and yet have a great outcome.
Then why do I need a fund manager? Why can't I do fund investing on my own?
Look, I think
Hey guys, welcome to The Money Mindset. Now, on today's episode, we have with us Sandeep Jethwani, who's the co-founder of Dezerv, a tech-driven wealth management platform that has been gaining a lot of traction in the past many weeks and months. Sandeep has spent almost 20 years managing money for the wealthiest Indians across geographies and businesses. Prior to Dezerv, he was responsible for scaling the portfolio management business of India's largest wealth manager to $3.5 billion. Now, as I said, Dezerv, you've heard the name a lot in the last couple of months to a year. It's been growing at a very fast pace since its launch in 2021. And it's now sitting on an AUM of 16,000 crores. Happy to have Sandeep with us on the show today. Thank you so much for being here.
Thank you for having me, Sonia. And congratulations on your own journey.
Thank you. It's been a very interesting one, the last 1.5 years for me.
You know, we've been watching you on screen for the longest time. So when you made the entrepreneurial shift, it was also very interesting for most of us in the financial ecosystem. Ki yahan kya ho raha hai? So maybe we'll talk a little bit about that too.
It was not only an entrepreneurial shift, it was a mindset shift. For so many years, working in one particular format and then making that transition to something I absolutely didn't know anything about, was very scary, but it is the best experience I've ever had. And it's very exciting because, on in a news like in a TV platform, you're constantly like a hamster on a wheel, churning out content after content. There's no thought into it. And this is like you get deep dive. You do a deep dive into certain topics. So there's a lot of learning.
No, and it's very resonant because I remember when I made that shift to starting up, you've gone from a cabin to a very small office where you're pretty much figuring out everything yourself. And for us, the biggest unlearning and relearning was around how to leverage technology. Like financial services in India has been around for the longest time, been in the industry for 20 years, and there was a way of doing things, right? When you start reimagining that way, what is digital public infrastructure? What is account aggregator? How does the KYC can happen faster? How does an app work? I think those were very interesting things. So it just suddenly broadens your horizon also.
It is. And, I wanted to ask you that actually, because Dezerv has in the last 1 year been everywhere. A lot of people are talking about it. I'm sure you've heard that. But this is such a cluttered space. So what is it that you did to stand out from the clutter?
Actually, Sonia, I think it is not as cluttered a space as we would think, right? So there are, and I'm going to round off numbers for effect, as good wealth managers will. There are nearly 1 crore crorepati households in India, right? And there are 10,000 relationship managers, give or take, servicing those households, right? So that's 1 for every 1,000 households, right? Now, this number for the US would be 1 for every 10 or 20 households, right? So that's the level of under-penetration that is there. Now, over the last few years, courtesy of what happened during COVID and people's familiarization with technology platforms, and also the government and regulators' interventions, a lot of access got solved for. Like today, for most part, there isn't a confusion about how to invest. What is a brokerage account? What is a demat account? What's a mutual fund? There are nearly 5 crore mutual fund investors, 12 odd crore demat accounts, etc. So penetration here. The challenge for most of these people was where to put in the money, right? And when in absence of that, what were most people doing? They were going online trying to figure out where to invest or talking to friends, and essentially ended up copying the portfolio. So our biggest insight was that India's wealth creators are not having portfolios built for them, right? You can easily replicate something that is online. Like one of the best or most popular search strings on Google in context of mutual funds is best performing mutual fund, right? What does that mean? That means people are keen on mutual funds, and they rightly should be, but they're looking up the best performing fund and investing in that, right? And okay, obviously the outcomes are not great. There's a concept of mean reversion and so on. So our insight was that people who've created this wealth, who essentially built themselves up, came from humble middle class backgrounds, are not managing their money really well.
So, before I get into all of that, right, your journey has also been very interesting. You were with one of the biggest wealth managers, and then all of a sudden you decided to move out and create your own brand. What made you, do that? And I like to learn from people who do that. I understand, I meet a lot of people who do that, but I understand that their journey is so exciting and so terrifying at the same time. But was it the same for you?
Uh, Actually, this the backstory is that my parents were the first generation recovering from the partition era, right? So they worked in public sector banks, sort of as my mom was a teller and dad was a manager, and sort of worked their way up in the banking system. So there was some discussion around money always happening in the house, right? In two ways. One is that there was this thing कि यार आज कोई आके 5 लाख रुपया डिपॉजिट किया, and that was like a big thing. If you go back to the 80s and 90s, somebody having that kind of money. And also there was this thing here, we don't have enough of it. Because I remember this, we are three boys, me and my other twin brothers after me. And we overheard this conversation once when the school increased monthly fees by 10 rupees. And mom dad in their bedroom were talking about कि यार अब कहाँ से cut करें? मतलब what will we cut so that we can send the boys to school, right? So there was always this realization money is important, right? Uh, Started off as an engineer, studied computer science in the peak of the tech bull run into 99 2000, and realized very quickly यार मुझे money के साथ ही काम करना है. So I went into IIM Bangalore. From there, joined Kotak in the early days when Kotak was a new bank, right? So this is the heydays of the banking, and markets were going up. You'll remember 2005 to 2008, practically on a monthly basis, markets would go up 3-4%. And then the real moment of shaping happened in 2008 when the markets completely collapsed. Nifty was down 60%. Kotak stock, now today it's a large cap stock, well respected, that stock was down 70%. The company which I had joined in 2008 or to start the wealth management business, the parent stock was down 90%, right? So suddenly it was like, look, people can make money, but you can also lose a lot of money. And in some sense, that shaped how we think about capital. And that in the next 13-14 years was very enriching. It is just fascinating that somebody from a lower middle class background has been given the right to advise some of the wealthiest people in the country. Like if you think about it, it's funny at one level, right? कि यार आप मतलब हो कौन? But at the same time, industrialists or super wealthy people who built like large industries would ask me कि यार ये mutual fund or where to invest, and they're having conversations around markets and so on. So that was very enriching. The real moment of truth for us was during COVID. And there was this time when people were batchmates who had gone on to do really well, were reaching out and saying ki, Sandeep, markets are down, ek baar portfolio dekh le mila. And I was like, sure, send it. And we would collect the portfolio, analyze it. And you would always step back and think about how did such a smart person who's done so well in their life come to a portfolio like this, right? There were 110 mutual funds. There are ULIP policies in the portfolio, random stocks, and so on. And that was the realization that there is a category of people who are wealthy but time poor, right? you have the wealth, but you don't have the time. And then how do they manage their portfolios? Who is really helping them? And that was the light bulb moment of sorts when you feel like, wait, there is nobody helping them. And maybe we can leverage technology to access them, to be able to give them the right guidance. So that was when 2021, Sahil, Vaibhav and I, we said that this is it. This is our calling. And we've got to scratch this itch. And that's when we left to start Dezerv.
So that's a very interesting story, but it brings me to a thought about the middle income trap, right? And it's because you told me you're from a middle class family, you're from a family, and I'm the same. Like my parents were also living paycheck to paycheck, and a little extra expense here and there would cause them to completely panic. How does one, and today there is a huge middle income class which is stuck in that rut. How does one, what is the problem currently, and what is the solution to that problem according to you?
And I've been thinking about this a lot, and I'll talk about one aspect of wealth creation which we are very passionate about. The fact is that what is a compounding asset that can help you sort of generate that escape velocity where you break out of the middle income and are comfortable financially? And frankly, in India, that's only been some sort of access to equity, right? If you have ownership in a business, either as a passive investor or as a employee shareholder or as a SME owner or as a tech founder, only then are you really truly able to break out of that situation, right? So most of us are in some sense renting our time, right? We are working at a place, and for that we are getting compensated. So it's like the hours that I spend, I get paid for those hours. Where is the real upside, right? How do I get that upside? And for us, for me personally, that upside was ESOP ownership in the companies that we were at or we helped build. And that really helped break out of that middle income trap, as you call it, right?
Okay. So, you handle a lot of portfolios of the wealthy in India. And I want to talk about some of those secrets. So, what we're going to do is on the show, we're going to do some live analysis of a few portfolios. And, we're going to get down and dirty to discuss what people are doing right and what people are doing wrong. Okay. But before that, I also want to check with you on, if you had to just an overarching theme of, if you had to tell us in your assessment of people for so many years, what do you think the biggest mistakes people have made in their portfolio which has caused them to kind of just not benefit from the power of compounding?
I think the very first thing is appreciate or understand compounding, right? There is a reason why it's called the eighth wonder of the world, right? I was recently talking to a group of people at IIM Bangalore, and I was telling them that if you spend 5 lakh rupees a month today, and you're 45, by the time you're 60, you will be spending 20 lakh rupees a month, right? Just compounding at 10%. And most people don't believe it. It's like, you must be smoking something. It's not right. It's not possible. I will never spend 20 lakh rupees a month, right? We took that to the next insight there, that to be able to generate or that kind of money when you're retired, you will need a portfolio of 100 crores, right? Because you live till the age of 90. Most of us hopefully will. Medical science is great.
Every person.
Anybody who has a 5
5
lakh
lakh.
rupees a month expense today
Oh.
will need 100 crores at the age of 60. So if you spend 2.5 lakh rupees, then you need 50 crores. If you spend 1 lakh rupees, then you need 20 crores. You can scale that.
Yeah. By the age of 60.
By the age of 60, right?
So if you spend 1 lakh rupees a month today, by the age of 60, you will need
20 crores.
20 crores in your account.
Yes.
Wow.
Yeah.
Okay.
20 crores in investment assets, right?
In assets. And this is not considering this 1 lakh per month spend has nothing to do with school, education, house, rent, nothing.
No, it includes all your current spend, because what happens today is that, there are certain expenses which you're incurring today, which you will not incur in, let's say, 5 or 10 years, but you will have other expenses which will add up, right? So suppose today I'm sending my kids to school, I'm paying their tuition fee, etc. In the future, it might be my healthcare, right? Or some other issues which will come up, or my parents' health and so on, right? So the expenses more or less stay the same. It's the combination of those expenses that will keep changing, right? So when you're younger, it's more about yourself, your own education. As you get older and you have a family, it's about the kids' education. But as you get older, it's about your healthcare. So the mix keeps changing. What stays more or less constant is the quality of life that you have, right? And Sonia, it's very, very hard to scale back the quality of life, right? You feel like in post retirement, I will cut back. But the question to be asked is, do you really want to? Like after retirement, do you want to step back? Do you want to not be able to enjoy the fruits of your decades of hard work?
Yeah.
Right?
In fact, if anything, post-retirement, I would want to
Yeah.
spend more.
Exactly. Exactly.
What
And
am I going to do with all the time? I'm just going to have to spend it somewhere.
absolutely. And the amazing part is that we underestimate what is happening with life expectancy, right? We will live longer. Like we put out this slide where we ask people that, what do you think? You'll live till the age of 75 or 80, right? And we actually put out data that nearly 40% of the people who are today 45 will live to beyond 90. We are getting wealthier. India is getting better. Healthcare is getting more accessible. We will live beyond 90, which means there are some of us who will live till the age of 100. And imagine you would have retired at 60. You have 40 years to fund, right? So you need to have a reasonably good sum in retirement. But the amazing part is that's not the compounding issue, that you need so much money. The compounding point is that you can make it. Because if you just compound your wealth at 14%, with some starting value and a reasonable SIP, which you step up at the rate of 10% a year, you can make it, right? So I think that's the point, that you have to be intentional about some of these things, right? We can't live in hope. We have to plan for it.
Definitely not.
Yeah.
Actually, this conversation suddenly giving me a lot of stress about.
That's not the idea. I didn't come to do that.
You said the amazing part. Nothing about this, conversation so far has been amazing. No, but I'm just joking. I completely get it. And I'm with you on this because, I keep telling people all the time, when people who are 40
Yeah.
tell me that, oh, it's too late for me to invest, I tell them that, today you're 40, but by the time you're 60, you'll still be poor.
Yeah.
You don't want to be poor and 60. You want to make some amount of money so you can live in your retire. And you have 20 years.
Yeah.
Right?
Yeah. And the mutual fund industry has done a fantastic innovation. This is unique to India. And today we take it for granted, but the concept of an SIP, right? I mean, it is a financial miracle that has been created in India. We don't know it, right? Why is that a miracle? Without actually realizing, you are creating an automatically compounding portfolio, right? Because once you sign up for an SIP, you rarely break out of it, right? It's a conscious decision to break out of it.
Correct.
It
It becomes a behavior.
It becomes a behavior, right? Typically, if in absence of SIP, how would life be? Every month, you would say, okay, now I have to invest 50,000 rupees or 25,000 rupees into the markets, right? And at that point, you would wonder, कि अच्छा अब क्या अच्छा लगता है, right? But this default debit to your bank account is the magic that the industry created. I actually feel that, in the US, in the 70s, there was this 401k revolution that happened, right? Where the government made it tax efficient. Everyone started doing 401k investments, which became the retirals for all of these people. And by the way, if that would not have happened, today a lot of elderly people in the US would literally be on the streets, right? That for us has been SIP, right? The fact that nearly 30,000 crores gets invested monthly, hardworking Indians are contributing their money back into the markets and compounding that is just amazing. Like for somebody to reach 20 crores, if you do 1 lakh SIP and start with an amount of 1 crore, in the period of 15 to 20 years, you can make it, right? That is just the fascinating thing for me. And we can talk a lot about how that helps India and capital formation, and you've studied all of that. But I think just for individuals, it's been fascinating.
So what do you say to those naysayers who, there's so much talk about how, SIP investing is just a scam, and of course, mutual fund managers come to the defense and talk about how SIPs have sort of made wealth for millions of Indians. Fair enough. But still, there is this narrative that, and also at a time now when SIP investing has not given returns for 2-3 years. What do you say to those naysayers?
I always think about what is the alternative, right? If there is an alternative, when you can time the entry into the markets, you know when to enter, you will be able to hold yourself accountable and put money at the right time, then by all means do it.
But now there's so many alternatives. There's the US markets, for example, which has been there's a whole gamut of international investing. The other alternative was gold and silver that people missed out on. So there are alternatives
No,
now,
so
right?
you can do SIPs even in those assets, right? I'm not arguing for SIP to be only done in equity mutual funds, right? You can do SIPs in whichever asset that you feel most comfortable about, which suits your, like you can do an SIP into a hybrid fund, right? If that's what your risk appetite is. Or you can do an SIP into a portfolio manager or with a wealth manager who will help you build that multi-asset portfolio, right? So there are many ways of doing it. The meta point is that you should be able to put money every month without having to take an active decision every month, right? And if you have better alternatives, you are a stock picker of sorts, by all means you should do it. But I think for most people who are in day jobs, whose life revolves around work and family and friends, this is probably the best thing to do.
Okay. One more last question, which has been lingering on my mind before we look at individual portfolios. So I mean, this is live case study. Okay. I'm almost 40 and I have an expense of around 2 lakhs a month, give and take here and there. How much would I need to have in assets by the time I'm 60?
40 crores. And
this is X of
the
a
house that you live
house.
in,
Okay.
X of the car that you drive, or maybe you don't need to drive a car now. There'll be other self-driving vehicles and so on. But I'm just joking. The point is that you will need 40 crores.
This includes, I hope, all children's education and all of that.
Everything, the full corpus, whatever the amount of, like to cover your future expenses, 40 crores in India for a mid-sized family, it pretty much will be a reasonable amount.
40 crores is a lot of money. I mean, I'm sure it's going to raise a lot of eyebrows.
I can do a portfolio review for you offline, Sonia. But I honestly feel that, and whatever I know of you, I think that number is very, very achievable.
No, I mean, see, for people who have been in this market for very long, they kind of know how, to navigate this market and maybe get to the figure, right? They must have done their numbers already, someone like me. But for people who are just starting afresh, these numbers are very intimidating. I mean, we talk about from 1 crore to 10 crore to 20 crores, but for people to even get to 1 crore is very hard the entire life.
It is very hard. I think, we actually did this journey of somebody who's doing an SIP and starts with a small amount of money. And let's say to getting to 20 crores, right? Over, let's say, a 30-year period. 70% or more of that money gets made in the last 10 years. Let me give you another example. We've all heard of how rich Warren Buffett is, right? Do we know that 99% of his wealth was made after the age of 60?
99%?
Yeah. And why is that? I mean, he's been invested for a long period of time. His portfolios have done reasonably well. And we all respect him. But the real thing is that he's been around for that long, right? When you're around for that long, which means you're playing the game of compounding and time, that's really where it really you see the value of it. And therefore, starting early is very important.
Okay. Well, let's get down to the meaty part now. I think what's going to stay with me so far is this 40 crore number that you've given me. It's going to haunt me, come in my dreams at night. But yeah, okay. So you want to start with the first portfolio?
So, what I really love about my job is that there's a story behind every portfolio, right? Like this individual, the first portfolio that we're going to analyze and try and figure out what we learn from this is of a young lawyer. She is, I think, 38. She's studied at the National Law School in Hyderabad. And she now works as a junior partner in one of the top law firms in India, right? So why is this important? Because she is not from an investing background, right? She's not doing this for a living. This is not her full-time job, right? So now let's look at her portfolio. We will come to, and Sonia, this is, like I said, what I do for a living. So we take everyone through a portfolio review. My team does this day in and day out. Now, here is the fascinating part. Over the period of her career, she has invested 2.7 crores, and that is now worth 6 crore rupees, right? So more than doubled her overall wealth, right? And one of the things I find super fascinating is that she is only invested in equity mutual funds. Now, if you take a step back and think about what she would be thinking, and I'm now imagining it in my head, if I were in her place, I would think that, look, I have a stable job, I have some recurring income. So can I have my portfolio in those kind of assets which compound? They might be risky, they might be more volatile, etc., but they will compound over a period of time, right? So she doesn't have fixed income in her portfolio. So that's something that is very, very interesting for me.
Do we know the category of funds that she has
Yes,
invested
we
in?
will go deeper into that also. I'll take you through that in a second. Um, and the thing is that this kind of simplicity can only come if you're one step away from the investing yourself, right? If you're day to day involved in figuring out where to invest, you'll sure have a lot of stuff in your portfolio, right? We all get tempted. So now let's look back. But before I do that, let me explain this concept of what we call missed gains, right? When you invest in the markets, you assume that you will get at least returns equal to the index. If I don't need anybody, I will go and put money in an index fund. The question is, do you do better than that or not? And that's really the test of performance in any portfolio, right? So now in her case, I love this. The fact that her portfolio has done 16.6% return and the index has done 15.6 in this time, right? And sure
That's
enough,
over how many years?
this is about close to 6 years that
Wow.
she's been investing, right? And which is why
What 6-year period was this? I mean,
this
was
was,
it
I
was
think,
not recent?
2019 onwards.
Oh, 29. Okay.
Yeah,
So she
yeah.
caught the post 2020
Yeah,
big
yeah.
recovery.
And you look, even if we say that, and this is like, how the fact the markets have not done well in the last year, right? So a bulk of this return would have come
Only in that
in
period.
the period prior to that. And maybe it'll average down to about 14% over a period of time, such a portfolio. But the fact is that even at 14%, you will double your money every 5 years, right? Again, we back to compounding. In her case, this 1% difference of return between 16.6 and 15.6 is 30 lakh rupees, right? And I think that's something that I find really amazing. In fact, we think that we should attempt to do better than the index by 1.5%, 2%, in which case we'll talk about an additional 30 lakhs could you do in a portfolio of this type, right? So now let's go deeper and let's see what is really working for her.
Yeah, I'm very curious to see what kind of fund she's invested in.
I am going to, unveil that in a bit, but let's look
Saving
at
the best for the last.
yeah, and we have to caveat this. This is not investing advice. This is specific to her situation. This is what she has done. I am not advocating that we copy this portfolio or try and replicate it, right? It's more the learnings out of it.
And also, you're not going to mention the names. You're just going to tell us the category of funds. Yeah.
Yeah, because it's not specifically about which fund you're in. It's more what you learn from this whole experience, right? Now, this is what, again, another thing that is fascinating. Her portfolio is done better than the index by 1%, and 50% of her mutual funds are underperforming the index. Right? Sounds counterintuitive, like that almost half of your portfolio is not performing, and yet you've done better than the index, right? And this takes me back to the Roger Federer insight, right? Roger Federer spoke at this commencement ceremony of a school where, and you'll find this on Instagram, it's a very fascinating thing. He talks about the fact that in his life, he won 80% of the matches that he played, right? But then he asked the audience, how much percentage of the points that I played do you think I won? And that was 54%. So 54% of the points or the rallies that he had, he won, and yet 80% of the matches. So it's more about consistency. All you need to do is to get 1 and 2 right? And you'll do really well in life, right? And this is not true of most of our life. This is true of investing, right? And that's something that is really cool. Now, this is her breakdown of her portfolio by category, right? She's had 50% of the portfolio in large cap, and the remaining 50% is mid and small caps, right?
But what's also interesting is out of that, almost 36, little more than 36% is in small caps.
Yeah. So she's taken a very aggressive bet. And, if I were to, I don't know how she got to this point, but I would imagine that she's okay taking more risk because in her day job, she has some security of income, right? And this is what I feel is like really special about investing. You can't copy somebody else's portfolio because it's built for their context, right? How much volatility or downside you can handle is very different from the downside that somebody else can handle, right? In fact, one of the first few questions we ask somebody when we try and build a portfolio for them, and people find it very amusing, sometimes they find it very weird. We say, how much money are you willing to lose? And people say, but I came to make money with you guys, right? But we are asking exactly the opposite. And in her case, it seems like she's willing to lose some bit of it, at least for the short term, to be able to make more money in the long
Gains
term.
in the long term.
Yeah, it's an interesting trade-off. Now, this is the list of funds that she has. I'll not go into specifics of the names of the fund, but it's also amazing that she's had a very large exposure to a small cap fund. That by itself is 35% of her portfolio. And that fund is not doing as well as the index. And yet she is doing so well overall. She has a bunch of flexi cap, multi cap, large cap funds. She also has an aggressive hybrid fund, which has some element of, or small element of cash and fixed income in the portfolio. One of the things you'll see that she's been investing since 2019, 2020. So to your question, she has been in the markets for a while. And she's also seen the 2020 collapse in the market, right? So she's been able to withstand that. She's not redeemed from the portfolio at that point of time.
Okay, I have a few questions here. So, in this fund, she has in her portfolio, she has a small cap fund, a very popular flexi cap fund, a multi cap fund, and a large cap fund. Now, the most obvious question is of portfolio overlap because the large cap funds, for example, most of them have a disproportionate amount allocated to, say, banks, right? And one of the most popular flexi cap funds also now has a very high allocation to banks. So, what do you do about portfolio overlap?
No, absolutely. And here is where, if you take professional advice, you would want to avoid significant overlaps in the portfolio. Because what most people don't realize is that a lot of the funds that we are owning in the portfolio are owning exactly the same stocks underlying. So if you were to think about the ultimate owner of those stocks, you are ending up buying the same set of stocks repeatedly, right? This problem actually compounds when, and we'll talk about it later in the show, about how people invest in outperforming or best performing mutual funds, right? Because the same set of sectors do really well. So this is something that's really important. In fact, one of the things I really encourage people to do is to create an overlap grid of their portfolio. Is to see how many funds that they have in the portfolio versus what is the overlap between those funds. And it's very insightful.
Also, since since it's a hot topic now, and I've noticed that there is that flexi cap fund there. What's your view on how a lot of these funds, or at least some of them, maintain high cash levels in their funds, right? The argument here is that if I have to give you money to manage, and you're going to just put it in FD, why should I give you? I'd rather just put it in an FD anyway. But then the flip side of it is that there's a reason why they're holding on to cash. Maybe they feel that the markets will correct more. But what are your thoughts on this?
So for every market environment, there's a certain type of a style of fund management that really works, right? There are sometimes managers who are value oriented and who do well when interest rates are high, when liquidity is tight, when growth is not secular, right? And then there are managers which do really well when interest rates are low, liquidity is high, which are called the growth oriented. Now, oversimplifying here, but the point is there are managers with styles, right? Now, when you give money to a value manager in a time when the market is expensive, you got to know that that person will hold cash, right? Because they will not be able to deploy against their own grain of or instinct of investing, right? So I think any professional advisor or wealth manager will tell you that this particular manager has this style. If you give money right now to him or her, they will hold cash quite likely, right? So in a sense, we are going in with our eyes open, right? And I would think that there's no right or wrong with this,
Yeah,
right?
of course,
You
of
have
course.
you have to be comfortable with
With
the
their
call.
ideology. Yeah,
Absolutely.
and
If you're
then
not comfortable with the
then don't
ideology,
invest with them.
then
Yeah.
don't invest in them.
But do you have
Absolutely.
any favorites in the fund management space?
You will get me into trouble. I have a lot of friends in the industry. But look, I think we like people who are consistent to their promise, right? What is very confusing for a wealth manager, if a fund manager has a certain style, or as advocates a certain style but lives a very different journey, right? But I think it's really good now that not only the regulator but also fund managers have become very aware of this style bias that they have, and they live true to it, because they know money has come in into their fund because of their style, right? So I think it's much better. But we like people who are consistent to their word. It's like, think about a friend who lives up to his or her promise,
You're
right?
still not giving me names. You're being very politically correct.
You'll have to pay me for that.
Okay, fair enough. Okay, let's move on then.
Yeah. So this is her portfolio. She has about I'd say about 8 or 9 funds, which is also very optimally diversified. She doesn't have a basket of funds. She's investing, by the way, in direct plans of mutual funds, which means she's not incurring expense ratio. Just look at this portfolio cost. She is spending about 0.5% a year on her portfolio. And this is again so cool, right? Like, you're making 16% and you paid only 0.5% a year. It's a great deal. And this is where Indian mutual funds have done such an amazing job, right? It's so well regulated. The TER, or the total expense ratio of the fund, is controlled by the regulator. In fact, recently in regulations, SEBI has brought down TERs even further, right? So where else would you get this kind of return with this kind of fees, right? I spoke about the fact that the portfolio is optimally diversified in 9 funds, and this is where it is. Now, what's the big takeaway, okay, for us? Do you see any stocks in our portfolio?
No.
Do you see any exotic instruments? No, right? And that is the real insight, that you can create wealth with simplicity. You can create a portfolio only of mutual funds and yet get wealthy, right? And this is something that people find very counterintuitive, that rich people in India are getting wealthy with mutual funds, because the common assumption is कि यार somebody is rich तो उसके पास बहुत कुछ अलग करते होंगे वो, right? ऐसा कुछ नहीं है, right? The rich can do simple things like mutual funds and still beat the markets.
It feels too easy. Like, it feels like, how can you just invest in a mutual fund and, then earn crores, right? That's the feeling that you get. But then I guess it's the compounding and it's the patience, the waiting game that really takes you there. But I had a question. How many mutual funds do you think a person should have? Because I noticed that she has about over 5-6 funds. What's the ideal number?
I think in a portfolio on the equity side, maybe between 7 to 8 funds should do it. Because beyond that, to your point earlier, Sonia, there is overlap that starts happening, right? It's only so many styles, only so many different underlying sectors or themes that fund managers can play. The more you spread it, the more overlaps you have, which then hurts your decision making. Like, tomorrow, if you have to redeem one style, you have to like execute a bunch of transactions, then you delay it and it never happens.
Okay, so let's move on to the next portfolio, because over there's a very interesting lesson, as you were telling me earlier, that the wealthy don't allocate their money based on past performance. And this is a very big mistake that people make, right? They'll go and they'll see, अच्छा पिछले 5 साल में इसका return 25% था, तो इसमें पैसा डाल देते हैं. But explain to us why that's not the right strategy.
I'll come to it, but again, let's go back to the story, right? Of this individual. This is a call that I personally was on. When I got on the call, so I was told that this individual is a business owner from Indore. And I thought that, I'll talk in Hindi, I'll tell him about how to invest and so on. And then I realized that he was a 40-year-old who had studied in Bombay, done his MBA from Bombay, and gone back to join the family business, right? And he could talk about return on invested capital, return on equity, as well as any other wealth manager would be able to. And I asked him that why did he get on this call? Because he could pretty much ring up any wealth manager. He said that because I didn't find one. And this is the point I was making earlier, that there are 1 crore crorepati households in India, but there are not enough wealth managers to serve them, right? So, and I love it when I meet people from tier 2 cities who built it the hard way. Because you would think that they don't know anything or they don't know enough about markets, but courtesy of all the education that you and other folks have done in the category, there's a lot of awareness of what's happening.
There is. And I think when you come from a tier 2 city or from a smaller background, there is this just inherent survival instinct, right? That whatever happens, you have to make it. Like there's no other choice. And then that just keeps you going, because I noticed that with some of the best market minds. I speak to a lot of people who have been creating wealth for years, and I noticed that all of them, even if they're from small villages in Rajasthan, most of them are from Rajasthan or small villages in Rajasthan. The thing is, they come from places which didn't have any resources. Like for Rajasthan, for example, right? Very few resources over there. They had to make do with whatever they had or create out of nothing. So they know how to survive everywhere. And there's a problem with being born into a privileged family, right? Like most of our kids, I don't know if you feel it, but I feel it, right, with my kid. Like he can't survive in a desert, for example. I mean, I don't know if I can, but he definitely can't.
No, it's a very, very, I self-rationalize ki why my kids will have other strengths. But this is true. I tell my parents that the only regret I have with them is that I was not born Marwadi. And they're like, we did the next best thing. You were born Sindhi. So, but no, I think kids today, there are two types, right? You can either become complacent or you can use the abundance that you have to be able to do better with life, right? And I hope that our kids will leverage abundance to be able to do better in life, right? So yeah, maybe that. But let's get into this portfolio.
So you were telling me the business owner from Indore.
Indore, right? And what I asked him is that where, like when I saw his portfolio, I was also asking him about how do you like invest your overall wealth? He said, this is a small portion of my total wealth. So I said, where is the rest of it? He said that, look, we have to own the land where the factory is. So a lot of my wealth that we have generated from the business has gone back in buying that asset, right? Because one of the things we always worry about is, do we own the land? Because if we do, then we will never get evicted and I can build more capex, invest better and so on. So a large part, 15 or 18 crores of his total wealth is in the land that he's invested in Indore to build that factory, right? Now, in his case, he has an 80-20 sort of a portfolio. 80% is in equity mutual funds, 20% is in fixed income, right? And it seems like he wants to protect his portfolio from downside risk, right? Which is amazing, because that means that he is aware of potential volatility. In his case, this is very important because his business will also be volatile during bad times. Right? We're recording this at the time of the Iran war. Oil prices are up, especially if you're importing anything which is built using petrochemicals. It is possibly more expensive right now. So it's hurting on the business side. And God knows portfolio is also hurting right now, right? So in his case, this 80-20 seems to work for him. Maybe in some cases it will be 60-40, depending on how vulnerable you are to equity markets or overall geopolitics, right?
Okay.
So that's his portfolio. Again, I find that he has a large amount in mid and small caps, right? And this is possibly also because in India, over the last few years, mid and small caps have done better. So if you've invested even lesser money in mid and small caps, the amount, because returns are higher, the end state looks like you've been higher on mid and small caps. So those parts of the portfolio have done better. Yeah. Now in his case, the 27 odd lakhs which he has in fixed income is in what are called short-term funds, right? Which means that he can redeem from them at any point of time. He is not locked into them. So it seems like he's keeping dry powder for a bad day or for putting into the markets when the chips are down.
Correct.
Now, in his case, the portfolio is done nearly 2% better than the index.
Wow.
Right? And I would argue that if he doesn't know this yet. He's one of the best wealth managers or fund managers out there because a 2% outperformance over a 7-8 year period is not trivial, right? And I think that's something that we have to give credit to him for. Now, let's look at why that is happening, right? 95% of his portfolio is in funds that are beating the index, right? And we'll begin to peel this onion. Ki kyun ho raha hai? Why is his portfolio beating the index, right? And that will lead us to the insight that we spoke about. So he has 5 funds overall.
He has 5 funds, correct.
A mid-cap fund, a balanced advantage fund, an aggressive hybrid fund, and then he has a banking fund and another flexi-cap. Incidentally, the same one that you were speaking about earlier. So he has 5 funds in his overall equity portfolio, but large part of the concentration is in the first 3, and that too within the first 2 is now nearly 80% of his portfolio, right? Now here is the fascinating insight. This is the mid-cap fund that he invested in. We have obviously cropped out the name. When he invested in this scheme, right, it was in 2021, right? Look at the quartile ranking of the fund. Okay, we have extracted this from value research. What is a quartile ranking? A quartile ranking shows you, assuming you were to cut the entire category into 4 buckets, 25% being the bottom, 25% being the third quartile, and so on and so forth till first quartile. Which bucket would this fund fall in given its performance at that point of time, right? So this fund fell in the 4th quartile, which means that in its category, it was one of the worst performing funds, right? Now, imagine what would have gone through his mind at that point. He's looking at the fund rankings by performance and saying that this fund is not done well, but I'll put money into that. It's not easy. It sounds simple. It sounds like, okay, you need to invest in things which are not doing well right now, but it's not easy, right? It takes a lot of guts to actually press that button and send money to that fund. He's done that, right? So he's invested in the 4th quartile fund, and that fund, if you see how it did in the subsequent year, 2022, it was in the top quartile. 23 again, it was in the top quartile. 24 again, it was in the second quartile. 25 is in the first quartile, right? So the point is that you can invest in underperforming funds and yet have a great outcome.
Okay, I have a question here. If you're saying that even if I invest in an underperforming fund, I can have if not a great outcome, similar to what I get in an outperforming fund, then why do I need a fund manager? Why can't I do fund investing on my own?
Look, I think first of all, we should be careful not to derive an insight that you need to always invest in underperforming funds. Yeah, like just because it is underperforming, I think the insight here is that chasing performance is not the right thing, right? Now, when you have that insight, what does it mean? It means that there are other factors that you need to analyze to decide where to put money. There are nearly 2,000 funds out there, right? Which one of those will you choose? You will not just stack rank them on performance and invest in the bottom, because sometimes there may be a genuine reason why the fund is bottom performing and will likely continue being bottom performance, right? So therefore, there needs to be more analysis, not less, right? You can't rely on only the performance metric. Now, either you do the analysis or you have somebody do it for you. And if you can do the analysis, you have a framework, you should, right? So the point is that the second order insight from this is that you should do more work in selecting the fund.
And not just go and pick up funds which are outperforming. I have one more question. In the 2 portfolios that we've seen so far, I noticed there is no investing into international markets, like no international funds. Do you think that someone would have missed out entirely? Because there's also the rupee depreciation you have to think about. If you have a goal, which is a financial goal, which is your children's education, investing in international funds makes sense. So why is it that in both these portfolios, there's no international investing?
Absolutely. See, first let's understand why international investing is relevant, right? It can come from 2 perspectives. One, it can come from a goal planning perspective, right? Like I need to send my kids abroad for education, and therefore I need to have some money in USD assets because this money will be required in USD, right? So if, like you said, rupee is depreciating, it becomes more expensive to send children abroad for education. you already have money in US dollars, it will help you, right? So that is one reason, which is goal planning approach. The other is from a return optimization or diversification approach, that it makes
Hedging
sense.
against country-specific
Country
risk.
specific risk.
Yeah.
You want less volatility in your portfolio. Now, sure enough, last year or two, international funds have done well, but there have been times when India has also done better, right? So, from a point of view of hedging, you should diversify, right? And our perspective on that is that maybe 5 to 10% of your portfolio having in global assets is helpful. We are big believers in the goal planning approach, right? Because it gives you a framework on how to deploy. Otherwise, I could be investing in anything, right? Like I could be investing in crypto, I could be investing in gold, I could be investing. I'm not a hedge fund. Most of us cannot operate as hedge funds, right? Because you can't even send money out very easily. There's a lot of friction, there's conversion costs. You know it that mutual funds have a limit on how much they can do. The $7 billion, and that limits get hit. Sometimes you have a set of funds that you can invest in, but you may not want to invest in those funds at that point of time, right? So I think there are real challenges to get to this 5 to 10%. But I think if you have a goal where expenses are overseas, you should almost certainly have that allocation. It's not easy again.
Yeah. There are
Because
many routes now, but yeah.
yeah, I mean, there is the LRS route and the
Gift
fund of
City
funds
route
route.
also.
Yeah.
Yeah.
LRS feeds back into the Gift City and so on. But the reality is there's a lot of friction even today.
Okay, that was very insightful. Just trying to understand how people invest and different profiles and different. I'm sure we'll do a lot more of that in the future. But Sandeep, before we wrap up, there is this one concept. There's so many mutual funds that people invest into, but the one thing nobody tells you is, of course, professional fund managers tell you that, but nobody tells you when to exit a fund. So for most of us, we buy and hold. But is that the right way to look at it? And if not, when should one be exiting or churning?
I think first let's answer the question whether it's the right to do that. Okay. Now, most people we saw have reasonable amount of small and mid cap funds in the portfolio. Let's use that as an example, right? There's this amazing study which Spiva does on how many funds are beating the index, right? So in 1 year, nearly 90% of small and mid cap funds are beating the index, right? But by the 5th year, this number comes down to 40%. And by the 10th year, this number comes down to 20%. What does this mean? This means that the fund which was doing well or beating the index in the first year or the second year is not necessarily the fund that will beat the index in the year 3, year 4, year 5, right? So buy and hold, we can debate, but buy and forget, certainly not, right? And this actually has implications on multiple things. It has an implication on the fact that you need to review your portfolio periodically. You need to size your portfolio. Sometimes you need to chip off some money from a fund that has become too large in your portfolio. And the third is you sometimes need to reevaluate which SIP is currently going in, right? I'm signing into an SIP for a fund, but in the 4th year or the 5th year, do I need to reevaluate that? Maybe, right? Sometimes fund managers move on. Sometimes the fund style changes. Sometimes the fund house changes hands. So there are many shifts that happen, right? And we love to say this, that good people, good friends, good colleagues are good forever, but funds are not good forever, right? You do need to review that. So yeah, that's something that we've learned. And this is not only true for India, but also the US, right? But in the US also, by the 15th year, 93% of funds that you hold in your portfolio are quite likely to underperform.
Oh, wow.
Yeah. So it happens all over the world. Everyone needs
It has
to
a
review.
life cycle, I guess. Every
Exactly.
fund has a life cycle.
Yeah. And what works when the fund is 1,000 crores doesn't work when the fund is 10,000 crores, doesn't
Correct.
work when the fund is now 1 lakh crores,
Correct.
right? So there's so many changes, and it's our job, I guess, to be on our feet and keep reevaluating.
Absolutely. And it was such a pleasure speaking to you because I got to learn so much, not just about how to approach portfolio management, but also, how your journey has been. It's been very inspiring to see the way you guys are growing. And I hope you continue to grow even better from here on. But I wanted to learn a little because my show is called The Money Mindset. So, and I believe that more than where you invest, how you invest, it is your own mindset about investing that matters the most. Because if you panic when, times are tough, then even if you invest in the best stock, it doesn't matter. So I want to understand a little bit about your mindset, because you've come from a middle class family where, you know, your parents were bankers, and you've gone through the whole grind, the IIM route, working in corporate, and now managing a company that manages 16,000 crores of AUM. What has been the biggest mindset changes in your life?
I think one of the things I learned is that, back when I started my career, I used to always talk to people who were great at stock picking and try and copy their portfolios. Right? आप क्या ले रहे हो? What is great right now? People would have these large Bloomberg screens around them, and they would be like, and I would peek into and figure out, कि अच्छा आप ये stock बढ़ रहे हो, should I buy it also, and so on. It's only in the last 10-15 years I realized that money is very personal, right? I cannot copy their style, their portfolio. I cannot even, because, if their size of portfolio is different, my size of portfolio is different, my needs are different, my risk tolerance is different, my family is different, my job is different. There are so many differences. Why should my money be managed the same way? Right. And I think and even in your question, your show is called The Money Mindset. Everyone has a different mindset. And so it's a sort of a nod to that. I feel that everyone should be very personal. After your family and your health, the third most important and personal thing in your life is the wealth that you have. So just being thoughtful, personal about it is super important.
But unfortunately, people talk so much about their health, good, bad. People talk so much about their family, but conversations around money are rarely dinner table conversations, right? I mean, they are, but very, very small percentage of
And
the
it's not
population.
not only true of India, and I don't know whether you'll cut this out, but John D. Rockefeller, there's this famous interview where he says that there were two things that were very clear not to be discussed on the dinner table: sex and money. Right. And which is very true. It's very awkward to talk about money, but I think we need to have more of that. People need to express about how they are managing it, and we are in a great position of privilege as wealth managers. We get an insight into the lives of people on their portfolios.
So, what is the craziest thing you've seen? I mean, I know one, you told me that you saw some 100 mutual funds or something in one person's portfolio, right? But what is the craziest thing you've seen in a person's portfolio?
One of the things I am very surprised about is people having no mutual funds in their portfolio.
So, then what do they have?
They have all sorts of random
Stocks.
some small cap, this and that, and people have bought into the story that there is a blue chip that you need to buy and forget, right? When I started my career, MRF was one of the largest stocks in the portfolio. Today, it isn't, right? I think the point is that there are companies which go through cycles, right? If you have the wherewithal to analyze, to invest time in research, go deep, go meet management, go analyze vendors, do scuttlebutt investing, and so on, by all means, you should do direct equity. But that's not the reality of most of us. And mutual funds are one of the most fascinating compounding vehicles. In India, it's cost efficient, tax efficient. You can do SIPs, reporting is clean, there's a custodian, there's a board of trustees, there's so much going on for you at the back that why would you not have? But I still see, unfortunately, and the funny part is that there are more demat accounts in India than there are mutual fund investors. I think that's a gap that we have to bridge.
So, when you spoke about buy and forget these large caps, right? There is one argument. I'm just playing the devil's advocate here, that all the bluest of blue chip companies, if you look at them, HDFC, ITC, Reliance, Infosys, and you know what I'm getting at, right? They've not performed in the last 3 to 5 years. And most mutual funds have these stocks. So then why am I paying for underperformance?
Yeah, I think the first question you should ask a manager is that should the fund manager be also investing on basis of past performance? There is a reason why they're holding the stock, because they believe that that stock will do a certain thing in the next year or the next 2 years, right? So even fund managers on mutual funds are betting into the future, not looking at the past, right? So I think it would be a little unfair to judge them on their past performance of the stocks in the portfolio, right? So I think we have to look forward and think about that. The other thing is that, index is a great equalizer. What happens in our index is that as the company does well, it becomes larger in market cap. And if your liquidity in the stock is there, free float is there, you also become a larger share of the index. So the index is also a great self-selecting mechanism. And therefore, it will keep the fund managers honest, right? So I think that's very unique. Look at Warren Buffett, right? I mean, even he trades. he's holding a lot of cash, as you know, right now, $380 billion. There are times when he's been fully invested. He's gone in the depth of the market. So he's also an active investor. So there's no reason why we all shouldn't be. Sometimes some of the stocks that we own that we remember a lot about is this concept of survivorship bias. We only remember the ones that do really well, and therefore it seems like we should buy and hold. We don't talk about the ones that fell by the wayside, who don't exist anymore, and we don't talk about them.
Okay, Sandeep, this was really a pleasure, and I would love to continue our chat, but unfortunately, we've run out of time, not out of questions. But thank you so much for being on the Money
Thank
Mindset.
you. Really enjoyed this one, Sonia.
Thank you. And once again, hope you continue to see a lot more success than you've seen up until now.
Thank you so much. It's early days, but thanks for the wishes.
And thank you guys for watching us on Money Mindset. Keep sending us your feedback.